Good evening, everyone, and thank you so much for joining me. We're going to start on Chapter 3. And I think the most challenging thing about Chapter 3 is the issue of debits and credits and the difficulty to understand how debits and credits work. So I'm going to address that, and I'm going to tie it in to everything we did in the previous weeks. So, well, before we do that, let's start with the first webinar questions, right? Because we're going to analyze the effects of transactions on the accounting equation. Then we're going to do debits and credits and explain how to record transactions. We're going to do the basic steps in the accounting cycle and prepare a trial balance. And actually, we're going to move forward and we're going to prepare financial statements so that we carry through to chapters 1 and 2, so that we're tying everything in together. So, but before we do that, let's do a quick review of account names and their definitions, which is what we covered last week. So we've got Q2-1. Now remember, I've given an example here on how we should address this, address a question. If I say, you know, what's the definition of this account name? So I've given an example, and then I've given 3 items. So I've got accounts receivable. Anybody want to tell me the definition of accounts receivable? I see a few people typing. Thank you. Dollars owed to you for supply of services or goods. Excellent. Money owed for service provided in the past to a client. So I agree with everything you said. I just want to switch the language because right now we're saying money owed, and I prefer to change it in the language of assets. So accounts receivable is the legal right. And your definitions aren't wrong, it's just the language you've used is a liability language, and it's more from the point of view of the customer than it is from us. So it's the legal right to collect cash from a customer in the future due to providing a good or service. So remember that assets are owned or controlled, and this legal right indicates that. And then when are we going to do this? In the future, which indicates future economic benefit because we're going to collect cash in the future. And then it's due to a past transactions, right, due to the fact that we have provided a good or a service. So it's referencing all of the elements of assets, absolutely. So keep in mind, we want to think about it in the language of an asset because this is an asset account. Services provided and money to be collected, excellent. Just remember, it's a legal right to collect that money. So yes, that's what we want to look at. All right, so let's go on to the next one, service revenue. Definition. What do we got? Cash received? No, you cannot say the word cash received. In fact, revenue is revenue even if we receive no cash at all. Revenue earned for services provided. Revenue generated from providing a service. Dollars earned and collected? No. So the definition of a revenue does not involve money. So you said dollars earned and collected. No, we don't have to collect them for it to be revenue. So income earned for service provided, absolutely. So remember that this is earned and it has nothing to do with cash or cash collections, nothing. The amount earned from service or product provided. Exactly. Do you see what we're saying? We're saying the word earned. So earned income from providing a good or service. Sorry. A service. Because we're saying service revenue. A service. Okay? And it does not it does not reference cash at all. And actually, revenue has nothing to do with cash. If I do my job, I have a right to claim revenue, even if I get paid nothing. And that's a really important distinction because accounting uses what's called accrual accounting. And the 2 hallmarks of accrual accounting is the fact that revenue is earned income from providing a good or a service. So past tense. And the second thing is that an expense is something that is used, consumed, or incurred to help generate that revenue. And never in those 2 things is the word cash. Cash is a side issue with regards to accrual accounting. It's not the first thing, it's just the last thing. So make sure in the definition of revenue and expenses, you never reference cash because cash does not matter. We will record revenue even if we receive 0 cash. So a lot of you had the correct definitions, the amount earned from service or product provided. So that is the key definition. The word money should not be in there. All right, perfect. So the last one we can put down here, dividends. And instead of asking for a dividends, I'm going to ask you a question. Do you think dividends are an expense? No, and you are correct. Because an expense is something that is used or consumed to help generate revenue, and dividends do not generate revenue. So whenever we're thinking about where do accounts belong, what element should I place them in, you really want to look at the definition of the element, because the definition of the element helps us to categorize all of the accounts appropriately. If the definition of the account does not match up with the definition of the element, then it doesn't belong in there. So dividends are a reduction in equity, and they're actually considered a distribution of the profits of the company to the owners. So dividends are not an expense because they don't match the definition of an expense. They are not used, consumed, or incurred to help generate revenue. They are a distribution of the profits of the company back to the owners, who own the residual amount of the company anyway. So we can move on? Excellent. All right, so now, last week, you'll remember, or not only last week, but the week before, we worked on the accounting equation, and I extended it in order to show you how it tied into the financial statement. So we're just going to reiterate that. Assets equals liabilities plus equity. We know equity is equal to contributed capital, also called owner's capital, plus retained earnings. We know that contributed capital is equal to three things: opening contributed capital plus issued shares minus repurchased shares. If we take all those three things, it's equal to the closing balance. Retained earnings is equal to opening retained earnings plus the profit minus the dividends, and that is equal to the closing retained earnings. Profit is equal to revenue minus expenses, and we already know the definition of all of these elements. Now, we also know how they tie into the financial statements. We know that revenue minus expenses is equal to the income statement. We know that the movement in contributed capital and retained earnings, so this center part right here, that is equal to the statement of changes in equity, and we know the ending balance in contributed capital and retained earnings plus assets and liabilities is equal to the statement of financial position. So we already know the whole tie-in. So then how can we bring this in to recording the transactions? Because when we record the transactions, we have to categorize them into the elements, because it's the elements that create the financial statements, and recording transactions, the end product of the whole process, is to create the financial statements. So that means that this understanding of this accounting equation should help us to record the transaction, and it does. So let's look at it. You'll notice that equal sign is there, and the equal sign is a balancing act. If the equal sign is a balancing act, then I should be able to draw a scale, and that scale should always balance. Now, if I look at that, we can see that this is on the left-hand side. So assets are the only thing on the left-hand side. Everything else is on the right-hand side. Well, that makes sense, because on the left-hand side is the assets, and on the right-hand side is everything that is owed to the people who financed or funded the assets. You got to think, when we borrow money, we're going to fund assets, right? If I borrow money, I'm going to get, the company's going to owe more money in the form of liabilities, but they're going to get cash, which is an asset. So 100% of the assets is owed either to the liabilities, third parties, or to the owner's wealth in equity. So this balancing act works perfect. And that means anything I change on any of these elements should automatically cause a change somewhere else in another element or in the same element. So if I'm looking at this big, huge scale, I can also look at a smaller scale. And as long as I keep the same conventions with the smaller scale as I do with the larger scale, everything should continue to balance. So looking at this, the guy who developed Keep in mind, by the way, that equity does not have any accounts directly connected to it. Like equity itself is just a summation. Liabilities actually has liability accounts, but equity is a summation of the equity accounts. So looking at this, I've got small scales embedded in the large scale because it's kind of like macroeconomics and microeconomics, right? The microeconomics is displaying the exact same characteristics as the big picture. So the small scales are looking the same as the big scales. Now, when the guy who developed this in 1461 was doing it, he was a mathematician and he wanted to be as straightforward as possible because this was very revolutionary in 1461 and people weren't really open to changing the way they were recording everything. Prior to that, the only thing that they recorded was in the cash account and everything else was ignored. And so here comes this guy who's a mathematician who comes up with this crazy thing. And so the mathematician thinks to himself, well, you know what? The easiest way to always remember what happens to the assets is to make a rule that if an account is on the left-hand side of the equal sign, if I want to increase it, I will always increase it on the left. So anything that increases assets will always increase on the left. And therefore, if I want to show that the asset is decreasing, I do it on the right-hand side. I'm going to make that rule. And the easiest way to remember that it increases on the left is to make it the same as the asset's location in the overall balancing act, on the left. So when he did that, he actually called the name of the left-hand side, he called it left, but he called it left in Latin. And the only thing we kept from that Latin is a short form called debit. Now, debit isn't how you say left in Latin at all, but it's a good way of thinking of it because all that debit means is left. It means nothing else. It doesn't mean plus, it doesn't mean minus, it doesn't mean good, it doesn't mean bad, it means left. And it means left for everything. This is also the left-hand side and the right-hand side because the right was called credit. And it doesn't matter which side of the equal sign we are on, we are still either on the left-hand side or the right-hand side, the left-hand side or the right-hand side. It makes no difference where we stand. It's always going to be simply the left and the right of these scales. That's all we want to do, left and right of the scales. In fact, to tell you the truth, we could call these two sides Fred and George and it would make absolutely no difference to how we run our accounting system. We could actually call it left and right and it would make no difference to how we run the accounting system. It would work exactly the same. So we've got to stop thinking that debit and credit means something. It means nothing except for left and right. Now, to make sure that everybody understood this, he decided that if everything on the left-hand side increased on the left, then everything on the right-hand side should increase on the right, everything. If an entry increases liabilities, it will always be recorded on the right-hand side. Why? Because liabilities happens to be on the right-hand side of the equal sign, not for any other reason but that. It's not because, you know, there was some secret or something like that. No, it's just because it happened to be on the right-hand side of that equal sign. And how easy is it to remember that the liability accounts increase on the right if not connecting it to the location of the liability element in the lovely balancing scale on the macro side, or on the macro scale, right? So liabilities, if they increase liabilities, if any entry increases liabilities, we will record it on the right-hand side, which is at the same location as liabilities itself in comparison to the equal sign. So that means if something decreases a liability count, we're going to record it on the left-hand side. Why? Because if right increases, then the opposite side is going to decrease. Over here, equity again is located on the right-hand side of the equal sign. And anything that's located on the right-hand side of the equal sign is going to increase on the right. Now, a lot of times students say, but that's not true for expenses and dividends. Dividends and expenses, they increase on the left. And I'm going to tell you that that's just ridiculous. That's just not true. Why are expenses and dividends recorded on the debit side, the left-hand side? Can somebody tell me why expenses are recorded on the left-hand side? What do you mean by negative? Yes, that's exactly right. Because they decrease equity. I love it when the textbooks say, oh, we got to put a plus on the left-hand side. No, no, no. Exactly. Exactly. Everything is in relation to its impact on this lovely basic accounting equation at the top of the page. So where else would we record expenses? Expenses reduce profit, reduce retained earnings, and reduce equity. Well, if that's true, and the mathematician thought, oh, how simple would this be? If it reduces the three elements at the top, then it has to be recorded on the reduction side for that element. Well, the reduction side for equity is a debit. So we're going to record all expenses right here. And we're going to record all dividends right here because of their impact on equity. There's no need to memorize anything. In fact, if we're in an exam and we want to remember, we just have to draw a very simple diagram like this, and it will tell us everything we need to know. If it increases assets, record it on the left. Why? Because assets are on the left-hand side of the equal sign. If it reduces assets, just record it on the opposite side from the left, which has got to be the right. The fact that we happen to call them debit and credit is just fluke. It's just, change it to left and right if it works better in your brain. I don't even care if you put it on the exam as left and right if it works better on your brain. So if there was a loss instead of income, it would be a debit as well. Absolutely. Well, what would happen, of course, is we would take all the credits from revenue, subtract all the debits of expenses, and guess what? The remaining balance would be a debit balance. So the whole thing, there's no secret about debits and credits because debits and credits don't mean anything. There's no secret about which side we should record them. Thank you very much. So there's no secret about which side we should record them on. The only thing you have to think to yourself is, does this business activity impact assets, liabilities, equity, revenue, or expenses? And then to decide whether you should record them as a debit or a credit, the only thing you have to think about is, oh, if it's an asset and it increases the assets, it's going to be on the left. If it's a sale of shares and it's increasing equity, then it's going to be on the right. Why? Because equity is on the right-hand side of the equal sign. Any questions at all about the whole concept? Or are we good to move on? Thank you, Joanna. Okay. Philip, all right. I see some thumbs up. Okay, good, good. All right, so now the first step in the accounting cycle, you recommend that we use this chart on the exam? Absolutely, Nuala. If this is what helps you think, because in the textbook, I mean, I've read textbooks where they actually recommend that students memorize it. All you've got to remember is assets, liabilities, and equity, and you just have to draw this scale, and it tells you everything you need to know. We just have to stop the confusion about debits and credits. They don't have any meaning. If you want to change them to the word left and right, do so, because they have no meaning at all. All we're trying to do is to record entries without using plus signs and minuses. If I record all the increases on here, then I can record, let's say $1,000 here. I don't have to put a plus against it because its location on the micro scale tells me whether it's plus. So I do recommend you think about it this way, because it explains everything about debits and credits, and it removes the confusion when we try to memorize things. I don't agree with memorizing things. I think we have to have understanding, not memorization. So now, if something reduces cash, I'm going to put it over on this side Why? Because it reduces cash. So I don't have to use pluses and minuses. The location of the numbers on either the right or the left-hand side tell me whether it's plus or minus. And its location is really dependent over here, is dependent on where the element is in comparison to this equal sign. That guides us. That totally guides us. We don't need anything else. All right, so now that we have a better understanding of the whole thing about debits and credits, left and right, we can then use this whole system to analyze business transactions, because we need to know the two critical questions for every business transaction. So from now on, I want you to start mentally using this. There's only two questions we should ask ourselves when we read a business transaction, and they're called critical questions. And I often forget to verbalize them for students, but I should be verbalizing them for students. There's one, and then two. Whenever there is an exchange, the exchange is always going to involve these two questions. What did the business get, and what did the business give away? Now, I use the word the business, but from now on, I'm going to use the word you. Your role moving forward in this course, from now until eternity, is going to be the accountant in the company. You are the accountant in the business. So when I say the word you, I mean the royal you representing the business. And so what did you, the business, get, and what did you, the business, give away? So let's do an example for a moment. The business provided a service to a customer, and they collected cash. So what did the business get? Cash. Absolutely. What did they give away? A service. Exactly. Because they gave away a service, what element is impacted? Exactly. Because of the no, not bank. Not bank. What element is impacted? Remember, it's the financial reporting elements. So don't forget the financial reporting elements: assets, liabilities, revenue, expenses, equity. So when you think about it, as soon as we say, what did we give away? Well, we gave away a service. That's past tense. If we gave away a service, it meets the definition of a revenue. So looking at this, what did we get? We got cash. Cash is an asset. Assets increase on the left. $25. What did we give away? We gave away a service. A service is revenue. Revenues increase on the right. Now notice this. We have something on the left which is equal to something on the right. Well, here we have something on the left equal to something on the right. It's a total tie-in. Sorry, would it not be classified as bank account in the asset? No, we don't use the word bank account. We simply use the word cash. So cash represents your bank account. All right, so now let's do another transaction. We're going to go back to our questions, and I'm going to say that a client gives you $25 and you plan to mow their lawn next week. What did you get? Cash. Good. $25. And what did you give away? Oh, no. I want you to tell me what you gave away. You're telling me the account. I want you to tell me what you gave away. A promise. Exactly. No. You did give away something, Nuala. You gave away a promise to provide a service in the future, and that meets the definition of a liability. And the account that would represent that is unearned revenue. So be careful, because often you give me an account name, but that doesn't answer these two questions. And the reason I want to force you to answer these two questions in detail is because sometimes you're going to come across transactions that you don't know how to handle, and there's no account name for it. And unless you can start thinking about what you actually got and what you actually give away, those things become really difficult to deal with. So we did give away something. We gave away our promise. We gave them an IOU. We gave them a promise, which is an IOU, and that's a liability because it meets the definition of a liability. So if we go back here, we can see what did we get? We got cash, and cash is $25. It increases on the left-hand side because it increases assets. What did we give away? An IOU, which is an unearned revenue. And an unearned revenue is a liability. It increases on the right-hand side, so $25. Notice that we've got the $25 on the right and the $25 on the left, so the right equals the left. We're still in balance. It's perfect. Now let's assume next week you go out and mow the gentleman's lawn. What did you get and what did you give away? Let's start with what did you get. Really think about this. What did you get? Nope, that's not what you got. No, we didn't get cash because he already paid us last week. We got a lower liability. But if at first we gave away an IOU, we have a fulfilled promise. We got back our IOU, right? We fulfilled our promise. We got back an IOU. So that means that our liability, unearned revenue, is going to decrease. A decrease from a liability is always on the left-hand side, so that's 25. So what did we get? We got back our IOU that we gave them last week when they gave us money. What did we give away? A service, which gives us the right to claim revenue. So over here, we would put 25. That is an increase in revenue because revenues increase equity, so they are always recorded on the right-hand side. So you can see how this understanding of right and left causes this balancing act to stay in balance, which is exactly what we need to record transaction. Every single transaction, once we answer the questions, what did we get and what did we give away, can then be recorded in the elements because that what did we get and what did we give away generally leads us to one of the elements: assets, liabilities, equity, revenue, or expenses. How would we record transaction once we complete the service? We would record the transactions exactly the way I said. Our liability, unearned revenue, would go down because what did we get? We got back our IOU, so we no longer owe anybody anything. And what did we give away? We gave away a service. And as soon as we say we gave away a service in the past tense, that meets the definition of the element revenue. Ruby, does that help? There is, well, we had an entry when they gave us the cash last week, and now we have a new entry when we actually provide the service. So now that we've figured out how we can analyze every single business transaction, we have to record it in what they call the Book of Original Entry, or the General Journal. So let's just do that for a second. We're going to record it in the General Journal. So the General Journal is a book of original entry. It's a chronological listing of every single transaction that we have recorded. So here we're going to put account names. And we're again going to use the debit and credit. And notice how wonderful it is that the debit is on the left-hand side and the credit is on the right-hand side. And we could even draw this, and it looks exactly like our balancing act, so there's no difference. The General Journal, when the gentleman developed it in 1461, he developed it to look exactly like the big, huge scale so that we could be tied into that scale when we analyze the transaction and when we record the transaction and when we put it into the TAccounts. It all looks the same, left and right. So we don't have a date. Let's say it's a transaction 1. I'm going to first record when the gentleman gave us the money. We would do a debit to cash because they gave us $25, and we would do a credit to unearned revenue because we gave away, which is a liability, right? This is an asset. Because we gave away an IOU, a promise to provide a service in the future. When we actually performed the service, what did we get? We got back our IOU, so that's a debit to unearned revenue. And remember, unearned revenue is a liability, so to decrease it, we would do a debit. Why? Because a debit is a negative under liabilities. And then we would credit revenue, because we What did we get? We got back our IOU. What did we give away? We gave away a service, and as soon as we give away a service, we have a right to claim revenue. Questions? Or are we good to go on? Do we have a clear understanding on what we're doing? Would it be the same to debit AR and credit revenue? So when you say would it be the same, it wouldn't be this scenario. In this, the only scenario where you can debit AR is if you provided the service and the customer is going to pay you next week. So let's think about the questions that we had, right? You provide the mowing of the lawn, and the homeowner is not, oh, you got it? I'm going to go through it anyway. You provide the mowing of the lawn, but the homeowner is not home, so you leave an invoice in the mailbox. What did you get? Okay, but you just said AR, which is the name of the account. I want you to tell me what you got. Nope, you didn't get unearned revenue. I love that you guys are using accounts, which is excellent, but you're still not telling me in words. Promise to pay from the client. Yes. Switch the language around. A legal right to collect cash from your client, which is accounts receivable. So that's what you got. What did you give away? You gave away a service. So if I look now at this, oops, wait, that's the wrong thing. So what did I get? I got the legal right to collect cash from my customer, $25. What did I give away? I gave away a service which gave me the right to revenue. Now, I can record it. A debit to accounts receivable, which is an asset, increases on the left-hand side, $25. A credit to revenue because I provided the service, which immediately gives me the right to claim revenue. Now, a week goes by and your customer drops off $25. Now what should I do? I should do the same thing. What did I get? What did I give away? I agree. I got cash. What did I give away? I agree with all your statements with regards to the account. The IOU. Thank you, Ruby. I gave the customer back the IOU that I got from them last week because accounts receivable is an IOU. So I got their IOU last week and I'm going to give it back to them. So this is going to be a credit to accounts receivable because that is an asset which is reduced. Remember, assets are reduced on the right-hand side. And I've got a debit to cash because that's what I got, cash. $25. All right, so we can see how valuable this whole diagram is in the recording of all transactions. And we can see that when we have got the transaction and we've used these questions, we can then record it in what's called the General Journal Book of Original Entry, which is a chronological listing of every single business transaction. All right, so do we have a very clear understanding about the whole process? Excellent. So then let's move on to the question. Just a minute, I'm going to go back here. Nope, that wasn't far back enough. Yes, that's far back enough. All right, now whenever I do a question, I'm going to put down my assets equals liabilities plus equity, and we know the equity does this, contributed capital, retained earnings, and we know this is 3, and we know this is 3, and this is of course profit, which is then down here, revenue minus expenses, right? I quickly do my big scale, and then I do my small scale, and I just put a plus on that side. That's all I want. I just want some way of remembering really quickly what's going on here, right? And so every account that increases equity, I'm going to put a plus on that side, and I'm indicating what side I'm going to record things on. But expenses are going to be recorded on the debit side because of the impact they have on equity. Same with dividends. Dividends are always going to be recorded on the debit side because of the impact they have on equity. Is it okay to use common shares instead of contributed capital? No, we should use common shares. Contributed capital is the summation of all forms of equity financing. So contributed capital includes preferred shares, common shares, you know, other things that are in there. So absolutely use common shares. All right, so we are ready now with this to do our transaction analysis. Once we've analyzed it, we also have to record it into the general journal. When we record it in the general journal, we also have to record it in the TAccounts. So we have to actually record it in accounts so that we can track the totals. Whoops. So we can track the totals. We need to track the totals in these accounts because we need to produce the financial statements. And we can only produce the financial statements if we have the total amount from each of the accounts. So we create a lot of these little T's, and as we need them, we put a new account name in it. I'm not going to indicate on every single one of these T accounts which side is plus or which side is minus, because I could just do this and just do a tiny little reminder up here, and that's all I need to do, right? That's the only reminder I need. Otherwise, these other ones are just going to be added as I need to add an additional account. I'm also going to put down date, the book of original entry, right? Account name, because I want to prepare. You guys already have this because I gave it to you, but I want to prepare. So now, I'm not going to be able to put all of the entries in here. So I'm going to make you guys responsible for recording everything into the TAccounts. Adding an account name, putting the numbers in there. I always turn my page sideways when I'm doing this, and I actually track all my T's under the elements, because that way when I have to create the trial balance, which is the summation of each of these accounts, it's a lot easier to do when I've already got them placed as per assets, liabilities, and equity. So are you guys ready? Because you're doing the key accounts for me. I'm going to do the book of original entry, and I'm going to analyze the transaction with your help. Are we ready to start this question? Or do I have to give you a second to draw up the T's? If you ask the same question as the expanded equations. Okay, wait a minute. Chelsea, what do you mean? If you asked the same question as the expanded accounting equation, do we have to use TAccounts? Oh yes, we have to use TAccounts. Actually, TAccounts are the only way that we can sum the totals. Nope, 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 nope. You cannot use plus and minus. Don't even think in plus and minus. No, we're going to do everything together in this question. Wait, where's my question? There we go. Oh, it says use the expanded accounting equation, but no, I'm extending that. I am going to use this question to do everything we need to do for the whole accounting cycle, right down to doing the trial balance and the financial statements. I'm doing the whole ball game. All right, so everybody's ready? You've got your TAccounts ready? And remember, we've got to ask ourselves the question. Whenever I'm asking myself the question, I am sitting looking at this particular chart. What did we get, and what did we give away? So we're going to do everything with this question. Number one, you make a cash contribution to your business, $3,500. Now remember, whose shoes are you standing in? Whose shoes are you standing in? Exactly, the accountant for the business, not you, the investor. You may be the investor in your own business, but you are standing in the shoes of the business, not in the shoes of yourself as the investor. All right, what did you get, and what did you give away? What did you get? Cash. No, you didn't get equity. You did not get equity. You got cash. What did you give away? We gave away shares. And shares represent ownership in the company. So we got cash, and the cash will increase by $3,500, and we gave away common shares, which is contributed capital, right? And contributed capital always increases. It increases equity, so it always increases on the right-hand side. So $3,500. So what did you get, cash? What did you give away? We gave away ownership in the company. And therefore, we're now going to record it in the general journal. Oops, not supposed to be capitals. Oh, would it be okay to just say owner's capital? Well, just remember that owner's capital relates to a private a sole proprietorship, and we don't deal with sole proprietorship. So don't call it owner's capital. It's either common shares or contributed capital, because we're going to think from this day forward in the eyes of a corporation, not a sole proprietorship. All right, so in that case, I don't have a date. I'm going to just use, if there's no dates, use a transaction number. Don't worry about it, just use the transaction number. We're going to do the exact same thing. We just analyzed it. We debited cash and we credited common shares. So we're not doing anything different, right? This was an asset, this was equity, and notice we're going to do that lovely debit and credit thing where the balancing act, well, equity is increased with a credit, so that's $3,500, and cash increased with a debit. Beautiful. Going back here, you set up a business bank account at Scotiabank. They will charge you $14.99 at the end of every month. What did you get, and what did you give away? So start with what did you get? Nothing. We got the right to use a bank account in the future. We got nothing. What did we give away? We gave away nothing. So this is not a transaction, and we would put down no entry. On the final exam, I expect you to put down no entry. In Wiley Plus, they expect you to put down no entry, and the reason is, in a normal accounting system, you would do nothing, but I can't read your mind and know that you knew to do nothing, or whether you just left it blank because you didn't know what you were doing. So please put down no entry, because it proves to me that you knew what you were doing. All right? Okay, so now we're going back to the accounting equation, and we say borrowed $4,000 cash from the bank. What did we get? Cash. Increased, which is a debit. What did we give away? A promise. Exactly. So this is a bank. It's a bank loan. So we got a bank loan payable. And don't forget, it's a credit, so we've got $4,000 over here. Now, I saw a question. Just a minute. When making journal entries, do you want us to use debit and credit in front of the account name or just indent the credit? I'm okay with just indenting the credits. I'm totally okay with that. I just do them automatically when I'm teaching. So 3 debit credit, we got a debit to cash because that's what we received from the bank, and we got a credit to the bank loan payable, which is a liability because it's an IOU we gave the bank and we are going to have to pay in the future. So it matches the definition of a liability. Beautiful. All right, purchase supplies for your business, $640 using a business credit card. What did you get? Supplies, exactly. Now, supplies go under which element? Asset, because it has future economic benefit. Absolutely. So supplies, and the supplies increased by $640. We know it's going to increase on the left. It's an asset. And what did we give away? Accounts payable, which is a liability, right? We gave away an IOU to our supplier saying that we would pay them in the future, $640. Remember, liabilities is increasing, and all liabilities increase on the right-hand side. So now we can put it in the general journal. We got number 3. We got a debit to supplies, and we got a credit to accounts payable, and that is for $640, $640. Back we go over here. Would it be okay to call that credit card payable? Use accounts payable. In a company, an accounts payable is everything that is owed and will be paid in cash in the future. It's what we recognize as the amounts owed to our suppliers. Transaction number 4. Oops, what did I do? Oh, you're right, you're right. I don't know what I was thinking about. Thank you. All right, we're back over here for transaction number 5. Paid your landlord rent for the month, $1,700. What did we get? Now, don't give me an account name. What did we get? Use of the space. Yes, Nuala, you've got it. Use of the space would indicate which element? No. The word use should have been like a red light blinking. Yes, yes, used, consumed, or incurred to help generate revenue. The very act of analyzing the transaction tells us which element it should go in, rent expense. So we're going to put down a rent expense, and the rent expense will be recorded as what? A debit or a credit? A debit, because not a credit. We remember that expenses decrease profit, which decreases retained earnings, which decreases equity. Which side decreases equity? A debit. So we're going to record the $1,700 over here because it reduces equity. So we got the use of the space. That's what we got. What did we give away? Cash. So we have to credit cash because we're reducing cash. So it's going to be a credit because remember, anything that reduces an asset has got to be on the right-hand side. So let's record it in our general journal. Transaction number 5, we've got a debit to rent expense and a credit to cash. And that's $1,700, $1,700. Okay, I need a new, just a minute. I've got the date. I've got the name. I've got the debits and credits. Over here, balancing act. Debit, credit. Okay, I'm ready. So we did that one. Now remember, you're keeping up with all of these T accounts because when we're finished, we're going to need to balance this so that we can create the financial statements. And if we don't have these T accounts and we don't keep them up to date, we cannot get our final summation number. All right, number 6, purchase a 1-year liability insurance policy for $2,400 paying cash. What did we get? And think about this, no count name. 1 year of insurance coverage, yes, you guys are getting it. So what is that? It's an asset, exactly, Polly, because its coverage is protecting us. It has future economic benefit. It's a prepaid insurance. Absolutely. It's increasing our assets, so of course we record it on the left-hand side. What did we give away? Cash. Cash is reducing because it no longer has a benefit for us because it's gone. So that is $2,400 over on this side. Absolutely. So let's record that into the general journal. Number 6, we've got a debit to prepaid insurance and a credit to cash. $2,400, $2,400. Absolutely. Okay, so now we're back here again. Number 7, paid $100 for business cards from Staples using your business credit card. What did we get? Business cards, absolutely. What are they? Which element do they impact? Assets, exactly. Now, I'm not going to put them in supplies because supplies I always think of as pens, pencils, paper, Staples, that kind of thing. I'm going to put it in its own section, exactly, prepaid advertising. That's what I think of these things as, prepaid advertising, $100. So that's what I got. What did I give away? A promise to pay, which is an IOU, absolutely. Not accounts receivable, Mark. Promise to pay is an accounts payable. Right. Absolutely. So we're back at the accounts payable. We're going to add $100 into the accounts payable because we owe money in the future. So now I can do transaction number 7. I've got a debit to the prepaid advertising and a credit to accounts payable. And so that's 100 and 100. Excellent. Back we go here. 8, provided services to your customers worth $2,670. You receive cash of $2,100. The other customer has promised to pay next month. So what did we get? Cash and a promise. Right. Thank you, Andrew. We got cash and we got a promise. Joanna, we did not get unearned revenue, because unearned revenue is when we owe something to our client, and that's not what we got. We got the client to give us an IOU, right? So accounts receivable, the client gave us an IOU saying that they were going to pay us in the future, and that's an accounts receivable. So we got 2 things, actually. We got cash in the amount of $2,100. And then we got the legal right to collect from our customers, which is accounts receivable in the amount of Wait 1 second. $570. What did we give away? Just 1 second. Service. Okay, now wait 1 second. Someone just, Chelsea. That is the title of the T account for the $3,500 debit. Just a minute, I'm not sure I'm understanding you. Credit. That is the title of the, I'm confused. What is the title of, okay, what is the title? You mean this one right here? Oh, this one over here. Got it. Common shares. Yes, that is. Anastasia. Yes. All right. Thank you very much. I didn't understand that. Thank you for clarifying with common shares. Okay. I totally lost my place. Where were we? We were saying the service, credit a service. Exactly, service revenue. We were saying we were crediting a service revenue. Absolutely, because we gave away a service in order to generate income, right? Income is providing a service. We provided the service. So that is the full amount that takes $2,670. Now let's just check. We got a credit of $2,670. We got a debit of $2,100, and then we got another debit of $570. It all balances out. It's a perfect entry. So let's do that entry. It's number 8. We've got a debit to cash of $2,100. We've got a debit to accounts receivable of $570, and we've got a credit to service revenue of $2,670. All right, moving on. You can see that if you're using this process, how much easier it is to think about the whole debit-credit issue. So when we read the transaction, why can't we give account names straight off the bat instead of thinking what we got and gave away? Because eventually, Andrew, you're going to run into a transaction that you've never seen before. And when we get into the habit of simply using account names automatically, we forget what those account names mean because it kind of becomes ingrained, and then you really get stumped on an exam. So I prefer that you think first of the actual what did we get and what did we give away, so you get used to it. And then when you come up with something different on an exam, it doesn't throw you for a loop because you've already gotten into the habit of thinking beyond the account names. You've thought to the actual transaction itself. Yes, exactly. Exactly. Because when students are in an exam, quite frequently they'll say to me, I don't understand this, like what's going on in this transaction? And it's because I've given them a transaction that doesn't automatically fit. And then they can't think their way through it anymore because they've memorized the account names. So that's exactly what I'm talking about. So just get used to thinking first, what did we get, what did we give away, and then automatically connect it to the account name. All right. What number are we on? We're on number 9. Yes. Okay, number 9. At the end of the month, you count your supplies, and you have 390 remaining. Okay. What did you get, and what did you give away? Oh, but there absolutely is an entry. We used $250 of supply. Chelsea, thank you so much. What element is impacted because of that? Expenses. Exactly. They used, so just be clear, they used 200 supplies. What did we get? What did we give away? Okay? What did we get? We got the use of supplies. What did we give away? We gave away supplies. So we got the use of the supplies, which is the expense. So the use of the supplies would be, the first one we had is rent expense, right? The use of the supplies would be supplies expense. I'm just going to use a short form, supplies expense. So we got the use of the supplies, 250. Okay, so what did we get? We got the use of the supplies. What did we give away? We gave away supplies, right? We gave away supplies. And look, if we do that, now what's sitting in our supplies account? The $390 of future economic benefit that we still have to use in the future. So looking at this and recording it in the account, I'm going to record it at the bottom here. Number 9, it's going to be a debit to supplies expense, because that's what we got. We got the use of the supplies. That is the, what did we say it was? 200 and, I've already forgotten. My goodness. 250. Thank you, Philip. And then we've got the credit to supplies, because that's what we gave away. We gave away supplies. All right. So now, looking back over here, you use up 1 month of your insurance coverage. What did we get? We got the use of insurance. What did we give away? We gave away insurance. Insurance expense, and the other side? And the prepaid asset, which is going to go down. Prepaid insurance, absolutely. So the prepaid insurance. Now, amount, and how did you calculate it? Exactly. Divided by 12, multiplied by 1, because it's 1 month. So if we look at that, that's 200 bucks. So prepaid insurance is going to go down by 200 bucks because that's what we gave away. And we're going to have a new account called insurance expense, and that's going to be the $200, which is going to, of course, reduce equity. So we record it on the left-hand side. We don't have a room here, so we're going to go back to the next, we're going to start the next page. Excellent. So we've got this as number 10. We've got a debit to insurance expense, and we've got a credit to prepaid insurance. $200, $200. It's totally tying in to what we already showed on the TAccounts. All right. The bank withdraws $27 from the business bank account to pay for the interest on the loan. What did we get? And think really hard about this. What did we get? Think outside the box, not an account name. No. Yes, Mark! The use of somebody else's money. That's right. When you think about that, that's what we get. Whenever we borrow money, we get the use of somebody else's money. That is no different than getting the use of some space. So interest is really rent for money. That's what we should start thinking about interest as. Interest is paying rent for using someone else's money. Rent, when you look at, when you pay rent for a location, you are paying rent because you get to use somebody else's space. When you pay interest, you get the use of somebody else's money. So as soon as we said the word use, we know that it's going to be an interest expense. So that's what we got. We got the use of somebody else's money. What did we give away? Sorry. Cash. Now, we need to, there we go, 27 and 27. So we need to do the journal entry. I think I'm on this page now. Yes. 11, we got a debit to the interest expense and a credit to cash, and that was 27. All right. The bank also withdraws the monthly fee for the bank account. What did we get? Bank account use of the bank service account. Exactly. So when we look at it, we've got bank fee expense. Absolutely. And that, what was the amount? Oh, $14.99. We know that from way up on number 2. And what did we give away? Cash. $14.99. Absolutely. So now we're going to record it. It's number 12. Debit to bank fee expense, credit to cash. It's $14.99, $14.99. I'm wishing now I had made it $15. All right, number 13. You have used up half the business cards. What did we get? Advertising. The use of the business cards, which is advertising. So over here, we're going to have an advertising expense. And half of the business cards, prepaid advertising was $100, so it's $50. What did we give away? Prepaid advertising. We gave away business cards, which is prepaid advertising. Absolutely. So over here, we've got 13. We got a debit to the advertising expense and a credit to the prepaid advertising. Exactly. So this was $50, $50. Last one, you pay the outstanding balance on your credit card. What did we get? We gave away cash, absolutely. What did we get? That's it, Joanna. We got our IOU back. Philip, we got our promise fulfilled, right? It's not that we got the credit card use. Don't think about that, Chelsea, because use is the word expense, and there is no expense right here. What did we really get? Whenever you think about loans, think about IOUs. We're either giving someone an IOU or we're getting our IOU back. So if we're giving somebody an IOU, the liabilities are increasing. And when we get back our IOUs, our liabilities are decreasing. So if we look at it way over here, right? What did we get? We got back our IOU. What did we give away? Exactly. AP goes down $740. What did we give away? Cash. I can't fit it in here, so I'm just going to write it over here, $740. Absolutely. I've run out of space again. Okay, so I'm not going to write down the date and everything like that. I've got number 14, it's the last entry. It's going to be a debit to the accounts payable for $740, and it's going to be a credit to cash because it disappears, $740. All right, so now we've finished all the transactions. We've analyzed every single one of them. You have TAccounts, and you should be able to calculate the total for each of these TAccounts. Now, many of them are given in that they only have one balance. Supplies, we've already got $390. I need prepaid insurance. We've got AR. We've got the prepaid advertising is $50. Notice when I total these TAccounts, I do not put numbers on both sides. They are always totaled on the side where the numbers are usually recorded, right? So assets tend to be recorded under pluses, so I'm going to put the balance under plus. So I don't, I often see that students put numbers on both sides. Don't put numbers on both sides. You've got to recognize the numbers only on the side where it is normally recorded. So even if it was a credit balance, right. So if we look over here, oh, you mean if it was a credit balance for an asset, would we put it on the debit side? No. No. We would put it on the, yeah, absolutely. On the side where the largest number resides. But in this case, for asset accounts, the largest number is always on the plus side. So balance is always where the normal is or where the balance is. Yeah, you can think about it where the largest balance is. Just don't put it on both sides. Prepaid insurance is $2,200. I have no idea what cash is, guys. AP is sitting under 0. At the plus side is credit, so I put it under. I've got the bank loan payable. Okay, so we've got two numbers. We got, oh, it's the same, 471801. Excellent. We've got confirmation. So that's what the number is. Everybody can note that down, 471801. Wait, I'm going to do that. 4718.01. Okay, where else am I looking? We've got the common shares. We've got the advertising expense, the bank expense, insurance expense. We've got the S expense, which I can't remember. Oh, supplies expense, interest expense, rent expense, and we've got the revenue. All right. So now, if we have done this correctly, if we add up all the asset totals, and we add up all the liability totals, and we add up all the amounts for equity, we should have a balancing act. If we don't have a balancing act, aha. So it should be 10,170 on both sides. Is it? Perfect. So now, where do we go from here? We create a trial balance. A trial balance is a tool that we use to do two things. One, check that the debits equal all the credits. And two, make it easier to produce the financial statements. So this is our tie-in, because there's no sense doing this whole transaction process if we don't tie it in to the end product, which is the financial statements. So let's do the trial balance first and then move forward from the trial balance to the financial statements. Whoops. Nope, one more. All right, so we're going to do the trial balance. We take the total of the T accounts and we create a trial balance. I got company A, trial balance. Trial balance is never published, right? It's simply an internal document that's used for those two purposes. One is to make it easier to produce the financial statements, and two is to check that all the debits equal the credits. It has an account name, and then a debit and a credit. And we know on the financial statements we never use debits and credits, right? So this is simply a listing of accounts. The listing of accounts is what's called reverse financial statement order. Financial statements, we always do the income statement first, move to the statement of changes in equity, and then do the statement of financial position. But here we start with the statement of financial position, and we start with all our current assets in order of liquidity, exactly the way they would show up on the statement of financial position. So I'm going to start with cash, and I put it on the debit or credit side depending on the balance that I just calculated. So literally we take the totals directly from our T accounts and dump them in to the trial balance in the correct order. Then I have accounts receivable, and remember that is 570. I have supplies, and that supplies is 390. I have prepaid insurance, and that is 2,200. And then I have prepaid advertising, which is $50. So now notice this order is so similar to what you would see, no, it's identical to what you would see on the statement of financial position under current assets. Once we finish current assets, we go to the long-term assets. We don't have any in this company. And then I go to the liabilities, short-term. Oops, bank loan payable. I just realized we don't have any short-term. We only have a long-term, the $4,000. Notice the $4,000 is going under the credit because it's a credit balance. So then we go on to common shares. So notice I'm just using the balances in the T account, 3,500. I go to service revenue, and that is 2,670. Then I go to rent expense. That is 1,700. I go to supplies expense. That is 250. I then go to insurance expense, which is 200. I have advertising expense. Ooh, I'm running out of space. $50. I have interest expense, and that is $27. And then finally, I have bank fee expense, which is $14.99. And then at the very end, I have total. And that total of all the debits better equal all the credits, which does. $10,170, $10,170. So remember, I said there's two things that the trial balance does. One is it makes sure all the debits equal the credits. And then two, it makes it so much easier to produce the financial statements, because by putting all of these accounts in financial statement order, right? These are the current assets. They're in order of liquidity. The items that will be converted into cash are listed first in order of liquidity. And then the items that will be used or consumed to help generate revenue are listed next. Then I would go on to the long-term assets or non-current assets. Then I go to the current liabilities, don't have any. Long-term liabilities. Then I do common shares. If this company already existed before, right here would be retained earnings. And then I do the revenue accounts, and then I do all the expense accounts. So I've actually got a format for the financial statements that allows me to produce the financial statements very rapidly. Now, a trial balance is wonderful, but it's not excellent. There are 4 errors that could exist that will result in the trial balance having a perfect balancing act. And so it will look perfect, but it won't be perfect. So an example would be, I don't know why I'm tripping over my words right now. An example of a problem with a trial balance would be, 1, a missed transaction. If I miss a transaction, my debits will equal my credits, but my financial statements will be wrong. What other error can you think of that would result in perfect balancing act, and yet it will be wrong? Wrong values. 2. If I'm supposed to enter $1,000 and I entered $10,000, it's going to be wrong. So wrong value for the entry. Absolutely. So that's another thing. When you say typo, Philip, what do you mean? You mean like a wrong value? Okay, perfect. Debit enter as a credit and credit entered as a debit. Now, that is the wrong account, right? I'm debiting the wrong account and crediting the wrong account. So every time I use the wrong account, my debits and credits will still work, but the amounts will all be wrong. So the wrong account also causes problems. Last one. We've got the wrong value for both debits and credits. We've got the wrong accounts for the debits and credits. And we've got a transaction that was totally missed. Yes. Transaction entered twice. Or even more than once. Absolutely. All of these things will cause the trial balance to be wrong, even though the debits equal the credits. So this is not the be-all and the end-all. It's only a tool, and it's not even a very good tool, to tell you the truth. If these things happened, they're going to balance, but it's not going to be right. Now, from this, we can create the financial statements. Remember what financial statements we're supposed to create first. We're always supposed to create the income statement. So let's just do that for a second. I want to finish this by creating the statements, and we can see the total tie-in between what we do when we enter our transactions because of business activities and how it flows through all the way to the financial statements. We're going to start, of course, with the income statement, because we need profit in order to calculate the statement of changes in equity. This is just for the month ended June 30th, 2016. We're going to start with revenue. I don't have multiple revenues, so I can just use the 2,670. Sorry, service revenue. I do have to have a title called revenue. I don't know why I missed that. Revenue, service revenue, good. Then we got the title expenses. And we've got rent expense. 1,700. We've got supplies expense. 250. We've got insurance expense, and that would be 200. We've got advertising expense, and that's 50. And we've got interest expense, and that's 27. And we've got bank fee expense, and that's 14.99. And then we have total expenses. Remember that income tax expense never goes here. Total expenses are 2241.99, and that will give us income before income tax, or profit before income tax. We don't have net income because net income is always after taxes, and we don't have that. So this is 428.01. There we go. That's what we're going to carry forward to the statement of changes in equity. So let's do the statement of changes in equity. Any questions about the income statement, what I just did, the format, the outline, anything? Or can we move on? All right, excellent. So statement of changes in equity. We got Company A, the name of the statement. We've got for the month ended, June 30th, 2016. Remember, it's the column approach. We got common shares. We got retained earnings. And we've got the total. We're always going to start with the opening balance. And of course, new company, 0, 0, 0. Then we're going to add in issued shares. Issued shares always impact, and for this, we look back here. Oops, nope. Got to go back a little further. Issued shares, there they are, the issued shares, right? Plus, so we know that they're part of contributed capital, and they're never part of retained earnings. Retained earnings is opening, profit, and dividends only. So we're never going to make any mistakes with regards, oops, one more. Never make any mistakes about issued shares and putting it under retained earnings. Issued shares was 3,500, nothing, 3,500. Issued shares never impact retained earnings. Our very flow chart tells us exactly what goes where. And then we have to say income before income tax. I'm going to use a short form, before income tax. Sorry, guys, but otherwise I'm not going to be able to get it in. 428.01, which we got directly from the income statement, the bottom of the income statement, right? So now this is 428.01. And then we've got closing. And these are the balances that are going to be moved over to the equity section in the statement of financial position. And then the total, remember, adds this way and adds that way. If it doesn't, you've done something seriously wrong. All right, so now we're ready for the statement of financial position. And remember, these closing balances will transfer directly into equity in the statement of financial position. So now we're going to do that. We've got, I'm going to move it over to the left-hand side because I'm afraid I'm going to run out of space and I'm going to have to go over. So we got Company A, we've got statement of financial position. I'm using a short form because I'm running out of space. I didn't move it over. As at June 30th, remember the change in the date, 2016 for the statement of financial position. We start with assets, move to current assets, and then we start with cash, which was 4,718.01. Then we do accounts receivable, 570, and then we do supplies, which was 390. And then we do prepaid insurance, which was 2,200. And then we have prepaid advertising, which was $50. And I think that was it. Then it would be total current assets. Seriously, I gotta learn how to spell. 7928.01. Now they don't have any long-term assets, so this would be the end of my assets because I don't have to have a total assets when I only have current assets. I can just leave it that way. So now I'm going to go over here. I'm going to start the liabilities. I don't have enough space. I probably have liabilities. Let's do it. Liabilities and equity. And then I start with current liabilities. Well, there is no current liabilities, right? None. So I'm going to go directly to long-term liabilities. And I only have one. I have the bank loan payable. And remember what I said, if we only have one, we don't need a subtotal. So the bank loan payable is going to go all the way over here at 4,000. Right? I don't have to have total long-term liabilities. You can, and I'm not going to negatively mark you because of it, but I don't have to have it because I only have one line item. So that's the long-term liabilities. I'm going to move into equity. Sorry, I can't continue at the bottom of the page. I'm going to do equity, and remember what I said. Equity is coming directly from the statement of changes in equity. So I'm simply going to put common shares, which is, of course, the 3,500. I'm going to put retained earnings, using the short form, 428.01, and then I'm going to put total equity, and I'm sorry, I can't put it far enough over. I would usually, put it way over here. I'll try and squeeze it in, 3928.01, and remember, that ties in directly, 3928.01, perfect. And then I'm going to do total liabilities and equity. And for that, I'm going to add the 4,000 in with the 3928, and guess what I'm going to get? I'm going to get 7928.01, which is exactly equal to the total current assets. So notice how the recording of our transactions, just one second, I'm going to go back here. Darn it. Back here. Oh, back here. There we go. So notice how the recording of our transactions into the elements creates the financial statements. This is the process to get to our end product. Notice how easy debits and credits are if we just think of it the way we were supposed to think about it right from the very beginning when this system was developed. It's just a matter of left and right and nothing else. All right, that's it for this evening. I'll see you next Tuesday night. Good night, everyone.